To prevent our money from going to waste over time, it's very important to properly manage our investments for the long term. That's why we created this episode to share 9 tips to maintain and protect your investments over time and not fail along the way. Hello everyone and welcome to Novarise, your channel for financial education. Managing your investments is almost a full-time job. Most people believe that investing is about money creating itself while you sleep. But the reality is that investing is about being attentive to trends, to monitor your performance, and the constant analysis of your assets, whether real estate, stocks, or cryptocurrencies. The task of maintaining an investment portfolio can become even more difficult in the long run, since we could be dealing with unforeseen circumstances beyond our control, such as inflation, economic crisis, or changes in financial policies. Now, let's get started with 9 principles to successfully invest in our future. But before we do that, do not forget to like this video, to subscribe to the channel, and to turn on your notifications. Keep your investment objective in mind. It's always important to have an investment plan, but we know that it can sometimes be difficult to stick to a long-term plan, especially when the future means 10, 20, or 30 years. In this case, rather than making a perfect plan about your investments, it's better to first know what your investment objective is. Do you want to live a full life after retirement? Are you thinking about college for your children? Do you plan on having your own business? Do you want to buy the house of your dreams? In our opinion, a long-term investment is anything that goes over 5 years, and assuming that you already know what your objective is, you should be able to make better decisions about what type of investments to make, how much money you should invest, and future plan of actions to help your portfolio evolve and increase over time. Urban Wealth Management financial planner Durin the King says that a person could take bigger risks when it comes to investing in their child's college education that's 15 years away. The reason why is because time will allow the investor to recover from the ups and downs of the market. Understand the risks of investing. Investing involves risks. When people fail to understand this, they set themselves up for disappointments that could lead to bad financial decisions. When you accept that you could experience losses no matter what type of investment you have, you'll have a better control of your emotions, which could translate to you making better financial decisions in the long run. This is not to say that you should sit still and do nothing. You should always monitor and learn about the market movements to decide on a proper course of action. For example, stocks are often a riskier form of investment than bonds. These are often impacted by news, economic policies, and third-party decisions. It's important to clarify that when we say that they are often impacted, we speak both negatively and positively. For example, on April 1st, shares on Twitter were worth $39. And on the day Elon Musk sealed the deal to buy the company, shares peaked at $51.70. This is an example of the impact of independent decisions on the stock market. Yes, some investment options are riskier than others, which is why it's very important to keep the following point in mind. Diversify, diversify, and diversify. We'll never get tired of saying this. The best way to maintain a profitable investment portfolio over time is to diversify it. The biggest benefit of this is that even though some markets could drop at some point, not all of them will drop at the same time, or at least the chances of that happening are quite low. Also, some markets could go up more than others, causing more of your gains to come from a specific type of investment. For that reason, our next advice is very important. Check your progress. Over time, the diversification of your portfolio will allow you to receive money income from a particular investment, so it's important that you always try to reach a balance. For example, let's say you put 60% of your capital into stocks. After a certain time, your invested capital could grow to become 75% of your portfolio. If that happens, it would be an excellent idea to reinvest part of that money in other markets to diversify your portfolio and keep it growing. It's very important to maintain that healthy balance in your portfolio. If your investment relies heavily on the performance of one sector, a drop in that sector could seriously damage your finances. Don't try to time the market. Many people try to move their money in and out the markets based on predictions about how the stock price will move. For example, when markets are expected to drop, many people try to sell their stocks just before it happens. Then, when the downturn comes, they buy more shares with the money they got and wait for the market to correct itself. This is what's typically referred to as timing the market. Timing the market is very difficult and it's also a risky practice. When it comes to stocks, you never really know when prices will drop or when they will rebound. Nobody can really know when a market will fully recover and return to healthy normal levels. Invest against inflation. Regardless of where you are, it's very likely that you've been impacted by inflation at some point, especially in today's circumstances. Even at a percentage that can be considered low, inflation can greatly impact markets in the long term. For instance, an inflation of 3% for 20 years can make a $23,000 car cost $41,540. A $1,000 item can be worth $1,800 under that index. Over 20 years, a relatively low inflation rate can cut your retirement savings in half, which is why it's so important to constantly monitor our investment portfolio and take the proper actions to protect it against inflation. Now, is there a solution for this? Well, investments are the answer. Historically, real estate increases in value and gives better returns over time. Long-term bonds are also made to keep your money protected. Stocks are another element that have overcome inflationary environments, offering competitive long-term returns. Be careful with investment costs. Investing has its costs. Whether in real estate, stocks, cryptocurrencies, exchange-traded funds, or any type of investment, there are always expenses related with each market. For example, if we talk about real estate, your expenses will vary according to the type of property you buy or the renovations and additions needed to bring the property up to market standards. When it comes to stocks or cryptocurrencies, we either need to acquire special equipment or pay memberships and fees to platforms that will facilitate our transactions. When it comes to investing in ETFs, you must pay an annual expense ratio, which is the cost of running that fund in a given year. In this case, it's recommended to make investments with expense ratios that are below 0.25% per year to lessen the impact of the cost in the long term. You may live longer than you think. Many people plan their retirement investments based on how much time they have left to live. When making projections for your old age, you must take into account that you may live longer than you planned, so you may want to consider including that possibility in your investment planning. Currently, a man reaching age 65 can expect to live on average to 84. For women, the average age of life is 86 years, and this longevity rate may continue to rise. JP Morgan research reveals that 68% of people think they need more than $500,000 for their retirement, but the average person currently has savings of around $130,000, leaving them with a tight budget to spend during the last years of their lives. What can we do about this? Our next tip is the ultimate solution. Start as soon as possible. The advice of all the experts is to start with your investments as soon as possible, even when there's little money. This will not only give your money more opportunities to grow, but will also give you more time to learn from the markets. Keep in mind that investments work like a snowball. Money invested grows, and if you reinvest the gains, all that money will just simply continue to grow. Invest early and reinvest in your portfolio constantly. You won't regret it. Now tell us, what investments are you making? Are any of them long-term investments? We'd love to read your comments. And don't forget to check out this next episode. Bye-bye!